Welcome to the last panel of the day, Risk and Uncertainty, Scaling Climate Impact Through Carbon Market Infrastructure. This panel will examine how market infrastructure such as ratings, market intelligence, and insurance can de-risk and build trust in carbon markets. I'd like to invite our distinguished speakers on stage, please.
Right. Right. Good afternoon, everyone. Thank you for taking time to join us today at this panel session, which is Risks and Uncertainties, Scaling Climate Impact Through Carbon Markets Infrastructure. Let me first start with a story that captures exactly why every one of us are here today. A few years ago, a major carbon project developer had pitched the perfect climate solution, which is that there is a project that aims to protect 800 hectares of pristine African forest, which is home to elephants, local communities, ancient trees, storing decades of carbon. The promise was simple, which is that instead of watching this forest disappear, the project developer will pay communities to protect it, so everyone wins. So what happens next was that corporates had started to line up to buy the millions of carbon credits that were to be sold. Sustainability reports featured this project, and CEOs talked about their commitment to protecting this forest. But the satellite images had told a different story. The deforestation rates that the project had used to calculate the impact was massively inflated. And project developers were selling credits for preventing deforestation that was never going to happen anyway. And the communities who were supposed to benefit from this never saw the money. Now, imagine if you're one of those companies that have built your net zero strategy around these credits, and you've reported to your shareholders, you've made public commitments, and told your customers that you're carbon neutral. It's all built on literally nothing, right? Your climate credibility has literally gone down the drain. Now, this story illustrates to us that this is the knife edge that we're all walking on, which is that for project developers, one failure can destroy years of work, and therefore off-takers like myself, every purchase risks buying promises that can evaporate instantly. This is why I'm delighted today to invite our panelists, right, who are three experts who are tackling these challenges from different angles. I have Tommy Ricketts from BeZero Carbon, is essentially building the carbon credit rating system for carbon projects. His ratings are meant to prevent the next version of this story. I have Lucien Georgeson from MSCI, is helping investors to properly price and integrate carbon risks into their portfolios. And Amy Barnes from Marsh is working on how to actually insure against these risks when there's so much uncertainty. So my question to each of the panelists is, how do you each define risks in the carbon market space, and where do you think there are still blind spots? Maybe we can start off with Lucien.
Sure. Hello. Yeah, thanks for the invite to this panel. Really excited to speak to you all today. And yeah, it's a great question. I think we would say that risk and uncertainty depends on what kind of actor within the carbon market value chain you are, and the kind of time horizon on the decision you're making, and sort of what kind of market you're operating in. So I think if you're a trader looking to buy credits right now, then there are certain risks about the risks or uncertainties related to the credit itself. If you're a country looking to trade with another country through Article 6, there are other risks associated with, will that correspondingly adjusted credit be delivered? What are the rules about how the authorization of that corresponding adjustment were given? So I think we look at it, you know, as a company that supports a variety of different kinds of actors with a variety of different tools. We're kind of defining risk and uncertainty depending on where you sit within that, the life cycle or the value chain on carbon markets, and then trying to see what is the information that you're lacking that could help you mitigate risks or understand uncertainty to deliver sufficient conservativeness, for example.
Thank you. And over to you, Tommy.
Thanks. So in a carbon project, I think there are three categories of risk. First, can you deliver the credit? So will you build it? Second one, can you sell it? And the third one, how good is it? And we focus clearly on how good is it, as in how do you understand the integrity of a credit, which has its own set of metrics. But it's important to note, will you be delivered the credit is incredibly important for anyone trying to actually forecast their exposures. There's a very different set of skills. So in the CDM market, delivery risk was the main thing that people focused on. Credit quality risk wasn't a really big part of that. So that will come back, issuance risk and delivery risk. And then things like moratorium, right? So if you've got a big stack of credits sat in a country and they just put a moratorium on selling them, what do you do? I mean, that's quite an important exposure to understand. So that's obviously policy, etc. On the carbon quality, three buckets, obviously, additionality, carbon accounting, and permanence. Well, do you need the money to do the project? How accurate is the science going into it? And will it be there for the period promised? From that, you build the rating as a foundation. But those three buckets, I think they all have slightly different roles, and they can be, you can have a very good quality credit, you kind of, designed it excellently, but you can't sell it. That means the whole thing crumbles. So I think written those three different ways, each one has a different solution.
So over to you, Amy.
So similar but slightly different. The way insurers think about risk is often about the peril, about the bad thing that happens. So if you think about your home, you are insured for flood maybe, you're insured for fire, you might be insured for accidental damage. Not all insurances cover you for bad things, whatever the bad thing. So insurers think about the risk from a very peril perspective. So building on Lucien's point of the three actors, the project developers, so the people who are actually sequestering the carbon, the funders, who are lending money to the developers, and then the off-takers, which massive kudos to the Singaporean government for being such a significant off-taker. So from a developer, when you talk about the delivery risk that Tommy was talking about, as an insurance company, they're thinking about non-delivery for a number of things. Is that caused because of, if we're talking about a forestry-based carbon, is that because of fire? Could it be pest and pestilence and a disease, meaning that the trees don't grow? Or if it's an engineering solution, is it a technology failure? Do we need to understand the technology better? We then also worry about, and I'm just putting insurance language on some of the things that Tommy said, we think about the political risk. That could be expropriation by a government saying that these credits are no longer available for international sale. You might be worried about acts of fraud, misstating, over-representing credits. As a lender, you're worried about the credit risk. If you lend the money to the entity, how confident do you feel that you'll get paid back the principal and the interest? So you may want to insure the credit risk. And then also reversals. Once you've got your credit, at some point in future, does the bad thing happen so the carbon stock's being sequestered? There are many more, but the insurance industry tends to think about it, let's name the bad thing, because if we don't name the bad thing, we don't know how to price the risk. If we just talk about general reversals, then it's really difficult for our industry to actually set a likelihood and therefore a cost of risk.
Right. So the three of you have highlighted quite a number of risks. Maybe from the perspective of an off-taker, could I just understand, what do you think is the greatest risks from the off-taker's perspective? And how do you think, we should be able to plug that risk?
Happy to. We were giving you the supply side, you were on the demand side. Okay. It depends how you look at it. Atmospherically, if you're buying a carbon credit, you are trying to buy a ton of CO2 abatement or removal, which you're trying to use for some type of, balance sheet reconciliation, basically offsetting. So your first thing is it doing the atmospheric activity it's supposed to be doing. So that would be should be your primary risk, right? That's not necessarily the case. The main case would be, am I somehow going to be exposed for having bought this and made a claim which has been found to be insufficient? Which you can say is reputational, but the reputation is baked on the idea that you've claimed an atmospheric outcome. So they aren't untwined. And then you've got stuff outside of carbon, which is very tricky to manage. So is there community engagement or some level of community engagement through to non-engagement or disaster and or perfect stuff, which you need to be aware of? So there's non-carbon related risks associated with that. But reputation will be very high. It's a very weird thing where you have buyer's remorse as opposed to seller's duty in this instance. And then it's your prerogative to say how much do you care about atmospheric side of it, and how much you care about the sort of wider impacts and whether they're actually achieving those impacts. It's that continuum. But there's the hard one and there's the soft side.
And as well as being an insurance broker, helping these projects to get financed and to work, we're also an off-taker. And we think very much about, I think you articulated very well, the reputational risks. We want to make sure that there is additionality, one of the challenges that you cited in the story that you started. But there's also it's not so much an off-taker risk, but it's a project risk. A lot of the projects need funding to start, and a lot of off-takers only want to pay upon delivery of the carbon. So this isn't specifically an off-taker risk, but it's a project financing risk. The fact that as an off-taker, I want to pay for the credits once they're developed, but there's that funding gap. And so if we can get more off-takers to invest earlier in the cycle, they've then got a credit exposure. Have they just paid for credits that may not ultimately be delivered? So it's a credit exposure and a non-delivery exposure.
Absolutely, I think it's those risks are always present, and it depends on that time horizon. If you're looking for a long-term offtake agreement, all of these side is that carbon benefit going to be delivered? Are the safeguards in place? Is this project having social environmental co-benefits are there? But perhaps for you in that transaction, that long-term risk is the bigger risk. Whereas if you're buying for more an immediate purpose, to buy in order to make a claim about your atmospheric impact today, perhaps it's the carbon, the carbon accounting side, which the atmospheric impact side, which gives the biggest risk. So I think it's both of these those are the two biggest risks, and just which one is the bigger for you as an off-taker just depends on your time horizon of the decision you're making.
So I think it's quite clear that from the government's perspective, certainly reputational risk is considered something that we are deeply concerned about. But let's move to the perspective of a project developer. In this day and age, what do you think are the biggest risks that project developers face? I know I heard that the financing risk has actually been highlighted because there's this conundrum, right, where as an off-taker, I'm unwilling to pay until you deliver, but the project developer is unable to get the financing before that. So, from a project developer's perspective, what do you think are the biggest risks that they are facing right now?
I think one of the biggest risks has to be where am I going to sell these credits, and what are the markets available for that? There's obviously a lot of interest in selling into international markets through Article 6, but that not only depends on the demand coming from a compliance market or from a government, but also then depends on your host country being willing to sell those credits and sell them abroad. So I think, and coming back into that question of companies and the claims they're making, I think a lot of companies are quite unsure about the claims that they can make right now, and therefore unsure what credits they should be buying, when they should be buying them, and what they can communicate publicly about that use of credits. So I think it's, that's the biggest sort of risk if you're a developer right now, is you want stable demand, you want long-term demand, you want to know that there's going to be a market for your credits, whether that's through a company or for a country, between now and the length of the project, which for a nature-based project is decades and decades and decades. And so just understanding, are you going to have a sufficient demand at the price levels that will make this viable is surely the biggest risk.
Yeah, to pick up on that, so if you're an interesting conversation I had with a developer of QuickStart developer, not the panel, speak to the panel beforehand. So they can produce reasonably low quality credits at $2.50 and sell them at $4. And I was trying to argue that if our ratings help get them a better price, they get a better rating, they should be making more conservative decisions. They should be investing more in their project, having higher quality data, more accurate science, and the price would do the work for them. Because if you imagine, it's volume times price is essentially what you're getting, right? If you're going to cut volume, your price has to more than do the work for it. So a big risk they face is, do they have confidence that they will be able to actually achieve higher prices to reward them for building better projects? And that's quite a lot to ask, let alone on the offtake side, on the financing side. And that's a very live and active conversation, because if you make it $4 and you sell it $2.50, you're guaranteed $1.50. If you make $3 million, then you can do the maths, right? Whereas if you need to sell at 20, who can actually pay 20? So then limiting your actual your number of buyers. So your liquidity pool starts to shrink because you've got more buyers at 5 than you have got at 20 than you have got at 100. So this is a very interesting live conversation, which is where do you, it's even more important for Packham conversations, but where do you draw the line on quality? And is it the cheapest to deliver at a given quality? And if that given quality has no flaw, the cheapest to deliver can be very, very cheap, right? And that's a very interesting conversation to be had. On the other extreme, your risk for long duration CDR is that you have a deflationary asset. I'm selling you something you know is going to be cheaper tomorrow. It's very irrational for you to be buying that. You only buy it if you're doing it basically for philanthropy or for innovation's sake. Because if your cost curve's coming down, that's also a risk. Because you're then basically saying to someone, I want you to be the irrational first actor to come in and subsidize future buyers so that they can do this. So you have these two very divergent conversations, which is one, will I execute a high enough quality project and will I be rewarded for a price inflation, knowing I can clear it at a low price? Or how do I convince people to pay an incredibly high price, knowing that if they're second, they can pay a lower price? So you have these very interesting dynamics for a project developer.
Extremely fascinating, yeah.
And not actually much to add to that, other than if we move away from the nature-based market into a lot of the technology-based markets, some carbon removals are at hundreds of dollars, and we need people to go in early to bring down the costs, and those developers are having to bet the fact that the cost curve will go down and the price will come up to make those technologies viable. And so there's also quite a lot of risk that some really innovative companies are taking, betting on those two meeting in the middle.
Well, I guess for the companies that are willing to take that sort of risks on the CDR credits that are so high priced, they have deep pockets. So I think that really answers the question as to who will actually buy that sort of expensive credits to take that sort of risks, knowing that the price will actually go down. You want to say something?
Yeah, I mean, I would just note that we do see a quality distribution at the higher end of CDR. So for biochar, we have a 4-point split. Even for DAC, we have a 3-point rating split. So it's quite a lot. This is a genuine discussion we have with long duration CDR cultists, is basically if you're an A-rated long duration CDR and your clearing price is $200 and you're an A-rated Red Plus project, that's an existential threat to that CDR movement, because the world should buy all of the A-rated forestry projects until the entire world's supply is gone before they should buy one of the $200 one if they're having equivalent atmospheric impacts. But clearly that's not a great marketing strategy. So you have a very interesting fracas between the industry on, which is what ratings provides an interesting window on, of like avoidance, removal, nature, and technology. There is an unwelcome Venn diagram of high quality, inconvenient avoidance projects which don't meet the narrative of removals is better than avoidance. That's just also fascinating. So to your point, if Microsoft comes in and they want to buy a high quality long duration CDR, as they're doing more of now, they're now looking at nature and technology. And I think soon enough they'll start looking at avoidance, because quality can be intrinsic to all of them and be equivalent. So that's actually quite controversial for many people.
So now we've kind of explored this idea of what sort of risks and the project developer's perspective, and also from the off-taker's perspective. I'd just like to understand more and switch gear to talk about what are some of the key risk mitigation instruments that we're seeing in the market that project developers, off-takers, and even the investors can look to in order to plug these so-called risks that they are facing in the market right now. So maybe we can start with Amy.
So I'm going to plug my fellow panelists, because the insurance industry don't want to be the police force of quality. They want to have a rating standard that they can underwrite against. They don't want to have to do the deep diligence on the quality of a lot of these assets. But if I think about physical risk management, when we think about from the developer's side, and we can think about some of the either reversals or the non-delivery risks, some of the things that insurers may want to manage risks are not things that we want as good for nature, good for biodiversity. So from an insurance perspective, I'd like a really big fire break. but we may not say that that's the best thing, that's the best either for the atmosphere or for the biodiversity. So there is a tension between minimizing the exposure to some of the physical risks and the outcomes that we want to achieve. But more than anything, the insurance industry would like the carbon industry to have standards and frameworks that it can underwrite against. It doesn't want to create those frameworks.
So, Tommy, I think Amy is suggesting that, that there's some work to be done by yourself. What do you say?
So you want me to invent a carbon rating agency, raise loads of money, hire 200 people, get Singapore government to back me? So, okay, I'll keep going. No, I think what we are talking about is, step back, is if you want hundreds of billions of dollars to come into this space, you have to build the financial information infrastructure to make it intelligible to that money. That does not compute to where it's come from. The way it was built was from very well-meaning institutions that weren't aligned with large-scale capital deployment and all the stuff that they care about. They were looking at lots of important areas, and to bring up that project that you mentioned, that project was the first dry forest REDD+ project in the world in pretty much the most corrupt country in the world. That's pretty pioneering work. You could say that 100% of that revenue didn't go to where it was. Still pretty pioneering. You do a REDD+ project in Mugabe, Zimbabwe. That is pioneering. I don't care how badly it went. So that's what they were trying to do, right? But that doesn't mean that computes to what people now want to be able to do, which is to say, is it real? Was there fraud? Was there all the other things? Sure. But at the very beginning, this was just pioneers trying to figure stuff out. But that's now transformed. So yes, they want the stack to resolve that. But that is also quite cognitively dissident to where it came from, which is people who are trying to just make the point that these things are very valuable. So you're seeing an evolution from the NGO backgrounds of activism and pluralism to much more mechanistic, hardcore information systems trying to actually get to the nitty-gritty of these things. And those are two cultures colliding, which are very interesting, and you're seeing around you.
I think that brings up kind of an interesting point on the age and the maturity and the growth of carbon markets, and that the scrutiny and the interest in addressing some of these questions that has appeared in really the last 4 years does not track with the amount of attention, investment, etc., that had been on voluntary carbon markets in the previous 20 years. So it's, as Tommy said, it's like it's an evolution, but it's an evolution that has had to happen very rapidly over a short period of time to try and get from something that was, was trying to work out the best way to do things on a relatively modest scale to something that is big enough to, move the engines of decarbonizing the global economy, even if carbon markets are one small part of contributing to that. So to come back to the question, what is needed, I think we need multiple sources of trusted, transparent information for across the different types of data that actors need to know. So we need trusted reference pricing for credits. We need, the market needs multiple people rating projects with slightly different methodologies so that, like the bond markets, people can have trust that every angle has been scrutinized because, 2-3 companies have looked at this project with different methodologies and come out with a similar rating. So it's then it kind of comes into that chicken and egg. So to get to that scale, that maturity of something that's able to operate in the same manner as the global financial system, that requires a huge amount of effort. And, it's how do you get scale versus how do you get this trust, and which one comes first? They're kind of going to work each other out along the way. And while that's happening, it's going to be a little bit, there's going to be a little bit messy.
Thanks, Lucien. I think you touched on price synthesis, which is something that's pretty interesting. And I thought that, I'd like to just ask this question in relation to what MSCI is doing in terms of, price synthesis, and that we all know that most of the carbon markets transactions are over the counter, and that there's not a lot of transparency in terms of prices. So what is MSCI doing on this front?
Yeah, so we've been tracking prices of carbon credits for quite a number of years now. As MSCI, we've recently relaunched that price tracking as a suite of MSCI indexes. So for those of you who don't know the background of MSCI more broadly as a company, outside of what we do on carbon markets, it is the largest provider of indexes and ESG ratings to the financial markets. So we have leaned on the 40 years of experience of indexes that MSCI has in financial markets to help improve the quality of the carbon price indexes that we're calculating. So we're tracking both the exchanges, and we also have through agreements with people who are doing over-the-counter and spot trading, we get their pricing data on an anonymized basis under an NDA. And from that, we're able to construct what we think is a highly trustable reference price through our indexes. As you said, from that we can say that in Q1 of this year, for example, about 90% of the prices that we saw in our tracking came from over the counter, which creates a wide range of options for buyers and where they can go to get their credits, but does create a challenge around transparency, knowing what isn't a fair price for a given credit, what's the going rate. And so that's what we're trying to address by getting data from as many sources as possible and putting it through as rigorous a methodology with the backing of MSCI that we can.
And now we've spoken about risks. We've also spoken about what are some possible ways to mitigate risk. The question is, how do we actually bring scale, right? So you're all so-called the carbon markets infrastructure players that is seeking to enable the carbon markets to scale, right? So what do you envision, is your role in helping carbon markets to scale, both from MSCI, from BeZero, carbon rating agencies' perspective, and also from Marsh's perspective, insurance perspective? Maybe we will start with Amy.
So insurance, if we come back to the three parties again, the developer, the investors, and the off-takers, one of the roles that I'm quite excited about that we're seeing insurance support the market is an example that's in the public domain. It's a US project, recent project. A large developer called Chestnut developing afforestation in California. Microsoft was the off-taker, and the lender was JP Morgan. And for JP Morgan to be satisfied and to lend to that project, they required that insurance was put in place against non-delivery. And so the existence of that three very credible parties, and it was insurance that enabled that project to happen. Now that's just one example, but if insurance can either make finance cheaper because the banks can give a lower cost of capital because they have the security of insurance, or it can actually unlock the loan itself, I think that's a really important enabling role that we have. And there are other parties are buying the insurance. Some developers are buying it because they think they can have a differentiated product by saying, I'm selling you a carbon credit that is insurance backed, so I'm providing you with sort of an indemnity against a reversal in future. So we're hoping that some of these financial tools will improve the confidence of the off-takers or the lenders to make more projects happen faster and at more scale.
Tommy?
Well, I think we just need Singapore to keep backing the market up.
Sorry?
We just need Singapore to keep paying for everything. Otherwise, this all goes away, including everyone's coffees and treats. I mean, I think we're trying to figure out what it takes to build a new financial market. There's not been many built, really. There's derivatives in the late 80s. There's been a couple of ones built since then. This is a particularly fruity one because you've got climate science, not financial analysis at the heart of it. And yeah, I mean, we think project level, our whole thesis is project level analysis on top of standards and thresholds, etc., make for a better outcome because it breaks the binary calculation of the market. Either you pass or fail if you pass a methodology, which means either you're 1 or 0. And if you're not 1, by definition, as in you're not perfect, by definition you're imperfect, and therein lies the greenwashing risk. That's a false binary. You don't need to have it that way. You can actually have price doing the work for you. So you understand that they're high quality because they've met all these thresholds. They might even be insured. but they might perform differently, and you bring that into the equation, then low prices, low quality, high prices, higher quality, that starts to reflect the market mechanism. But if you don't have project level risk in that mix, you're just constantly trying to reset the bar higher and higher, but that doesn't really solve the problem. So our whole thesis is, through project level analysis, you get a much better market structure, but that's also my sales pitch. So,
Lucien.
Yeah, so I think we see our role on one side being to be a trusted supplier of data and analysis and information for those main actors across the ecosystem. So to help them take better decisions, and therefore to help more people come into the market and help larger actors come into the market as well. So, to get investors on board, for them to be able to comfortable taking on board these risks onto balance sheets, you need investment grades information. So they need reference pricing, they need robust forecasts, they need multiple sources of ratings on the projects, of which there are many, in couple on the stage, and they need multiple sources of information. So we want to be one of the the key providers providing that information, and we want to help investors as well, companies, understand where carbon credits fit within a broader climate strategy. So where does the use of carbon credits fit within a company's transition plan, credibly? So whether you're a company trying to work that out, or whether you're an investor trying to understand what action your company's taking, the companies across your portfolio are taking, we want to be able to provide you that information, combining what MSCI does on carbon markets with what we do elsewhere on other climate data, to provide that kind of complete picture for investors and for companies as well to benchmark themselves.
So thanks, Lucien. I'll build on your point. I think there's been a lot that has been said about what Singapore has been doing on the Singapore carbon markets front. And in relation to how corporates are decarbonizing themselves, I think we have just put out a guidance on how companies should be looking at carbon credits to be used as part of your decarbonization plans. So that gives really more certainty in terms of companies coming into carbon markets and using carbon credits and knowing what sort of carbon credits that they can use in order to then use towards their net zero goals. But on top of that, what I'm hearing is also that the market is looking for demand signal, and that's what we have done. So last year there was a request for proposal on nature-based solution, and we awarded just this year US $60 million worth of projects in a few countries, including Ghana, Peru, and Paraguay. And so that is a strong demand signal that we sent out. The latest RFP that we put out, which is on 31st of October, that one is actually sector agnostic. And I welcome interest from the floor to participate in that RFP. And that is another demand signal that we're putting out to the markets. And I hope that that address some sort of like the so-called the key risk that Lucien highlighted, which is that, who will buy my carbon credits? I think the Singapore government here is looking for Article 6 carbon credits. And we are welcoming project developers to develop projects in the countries that have signed implementation agreements with us. We have so far signed 10 implementation agreements, and project developers could explore doing carbon credit projects in these places. Now, I will switch gear a little bit and look a little bit more forward into the future. We've covered a lot of grounds on risks and uncertainty and the role that different market players can play to scale carbon markets. I'd love for each of you to take a moment and share your thoughts on this question. It's a little bit crystal ball gazing in nature, but not that far away, because I'm looking at 2030. If we were to reconvene in 2030, what sort of milestone, right, you hope that the carbon markets would have achieved that tells you that we have truly scaled carbon markets with integrity? Maybe I'll start over with Lucien.
Yeah, it's a great question. I think you'd be looking at what is the situation in terms of the market and the volumes of transactions across the different pillars of demand that you can forecast between now and 2030, now and 2050. So the kind of key milestones is are there more Singapores out there? Are there more countries that are giving that long-term demand signal, that are engaging in these deals, that you can say, look, 2030, we have a robust market with credits crossing borders with corresponding adjustments and going towards NDCs. You know, how has the last phase of the Corsia scheme for aviation finished? Was there enough demand was there enough supply of credits to meet that demand? Has that contributed to demand signal? And then I think the other example that has kind of been called on before is Microsoft. And I think the other signal you'd want to see is, are there more Microsofts out there giving these long-term demand signals? Because you can't have a growing global market being driven in part by a handful of companies and a handful of countries making those commitments. You need much more of those to give those stable demand signals. So I think that would be it. Those three things would be what I'd like to see.
Well, Tommy, over to you.
I think the first thing would be more countries like Singapore saying we're going to buy credits. Then that would be very helpful. So instead of pavilions, no, I think that's true. If you come to COP, whatever that will be, 34, 33, and the conversations are the global north is short, structurally short, because it's been polluting for 150 years, and we need the global south to be delivering, who are structurally long, that starts to become a mainframe conversation, not a side issue, but a mainframe conversation, because it's a huge wealth transfer. So just look at it in the hierarchy of how it's spoken about. That is not something that they're negotiating on, but they're actually then talking about the implication of billions of dollars flowing from the global north to the global south. That will be an indicator. So we can chat the policy dialogue. Second one would be, yeah, sure, obviously more buyers. I think what you'd see is clarity on how a corporate can actually make a claim. If you, and everyone in the room here can exactly explain simply how you could use a credit by 2030, don't worry, we're not going to be sitting here in this, we'll all be on Singapore's boat. But like, it will have exploded. That's the clarity, that's the problem. What can I actually use a credit for? Until you can actually explain that, if that's a 2030 achievement, that would be amazing. Because it would have meant that everything else is knocked in behind it. If every corporate knows exactly how they can use it, exactly why they could use it, countries are agreed, the whole thing, the show is at the races. So that's probably what you're looking for. Can you easily explain it? And is the global north really pushing the fact that it's short carbon at these agendas?
Amy.
I think that's absolutely the right macro ambition. I think at a sort of a more granular level that there is trust in the system, so we're not still questioning the validity of the markets. Despite being an insurance broker, selling insurance is what we want to do. We don't want to do that. We want to manage the risk, and the less risk there is, the better. Insurance is the outcome of the residual risk, but a maturation in that space, so it is an enabler, a de-risker of projects that ultimately reduces the cost of projects, so more projects can happen. And so some of that it comes from the credibility that is emerging all the time.
Well, thank you very much. So if I may summarize what you've just said, basically you're saying that by 2030 we hope to see more demand signal, not just from Singapore, but from all over the world, and as a result of that demand signal, more financing can flow from the global north to the global south. And finally, we hope to see a lot more clarity in corporate claims. And so that will give, again, it links back to demand signal. Because if you're confident on what you're claiming in terms of the carbon credits, I think that it will give you the confidence to then go out there and buy carbon credits, and therefore it adds to the demand signal. So I think the final point that Amy made, which was very insightful for me personally, which is how insurance as a product can potentially bring down the cost of capital, which then supports the project development for the longer term. So this is something that's been very useful. I will now open up the floor for questions and answers to keep this a little bit more engaging. So we have about 15 minutes, and I see that we have a good crowd here. For those who would like to ask a question, could I ask that you indicate your name and the organization that you're from? And I welcome questions.
Thank you. My name is Olga, and I am from Awaken Private Company in Peru. and next year we will generate the carbon credits with the Peruvian government on the 420,000 hectares of the Amazon rainforest. But to prepare for those projects, I spent the last 5 years basically living in the Amazon rainforest among the indigenous communities. I visit all of the RED Plus projects which are operating in Peru. So I want just to give you the on-ground insight. What would I ask the project developers if I would really want to develop the high-integrity carbon credits? So first, what I would ask for the Amazon rainforest at least is, do they work with the communities to advance the traditional agriculture? Why? Because one family, for example, in Peruvian Amazon is destroying 5 hectares of rainforest, burning basically for traditional agriculture per year. So if I have 100,000 hectares, I will lose 10,000 in 10 years just because of this agriculture. The second question I would ask is, do you have the acoustic sensors, drones, and AI protocols to detect illegal logging and fires? Because this is the second big reason why you basically lose your forest. And if you lose your forest, you lose your carbon credits, which is obvious. And the third, I would ask if you have real-time, 24/7 AI-based monitoring systems. So without those 3 things, I don't think you could really have high-integrity projects. And without those things, I think that the corporates, they will just lose their credits, So I would just want to ask more the project developers, do you pay attention to this, or how do you work with these risks on the ground? Because we were talking here about some finances, the stuff, but the carbon itself is in the forest. It's within the communities. So I just want to ask you this specific question. Thank you.
Sorry, could you repeat your first question?
Yeah, the first question is, do you actually work on the ground with the communities when you're entering the carbon project?
Perhaps we don't have project developers on the stage now, but I think Tommy would be the closest to answering these questions.
Sure. Sorry, you're right. We didn't go into the fine points of project design. I left it a bit more highfalutin for the sake of a bit more enjoyable panel. But at a very granular level, yes, you need real-time data. You need to have better models. The one thing I would say is that technology isn't necessarily indexed to better outcomes. Obviously, you need better monitoring, but in RED Plus, you can use exceptionally complicated models which tell you as little as just doing an average forecast. So applied use technology is very important. We go to the projects when we're invited. I'm going to one tomorrow. We do more on-ground testing of beyond carbon as opposed to as in non-carbon attributes because that's not the way to go and do ratings at scale. What you need is actually plots databases. So we've invested for 5 years in funding master's programs around the world in return for data to get an enormous database of plots data so that you can do reference analysis against the locations. So you don't need to have gone to the exact location of that project, but you do have to have contextual data to go and do the analysis from it. So someone in the forest very, very much next door to that one would have had to have been sampled. But if I were to go and remodel the entire project, I'm just rebuilding the project from scratch. That's not what we're trying to achieve here. So yes, at a very micro level, you need to go to communities for their own sake, and then you need to go and do analysis on the carbon sake. And for your point, stuff like fire breaks is a really interesting example. How do they deal with fire? Are they set up to deal with it? Et cetera, et cetera. You have to go to all of these things. The question is, you have to go and actually rebuild them from scratch to assess their assessment. No, not necessarily, but you have to have reference data to do that. So yeah, in the mechanics of how you do a rating, this is the stuff that you're actually doing.
Ted Cronmiller, Capturiant. Great to hear your perspective, and congratulations on 10 Article 6 projects agreement. So the question here is this: what are your thoughts on methane abatement in terms of meeting the Article 6 mitigation test?
I don't work at Packham.
Okay.
I mean, there are good projects, but it's the wrong. The advisory boards. I don't know. You have to ask those guys, right? But there is no reason from an integrity perspective that methane capture shouldn't be a massive part of that market. That's not necessarily the politics of the situation.
Thank you.
Yeah, absolutely. It is an important project type. There are very good methane abatement projects out there. There are ones that have more questions about their accounting. So part of it is about the expediency of getting this methodology approved faster than other ones, and they needed to get a methodology approved to show the progress. So I think it's it's the first step of many, of course, many project types, but I think this one was just maybe the quickest one they could get across the line.
Hi there, I'm Natalie and I represent project developers that work on mangrove restoration as well as methane abatement. My question is, what is the stance and what are each of your organizations doing to remove buffer pools in the carbon markets? Because we're really glad that insurance has come, and I think we all know that buffer pools were meant to be a temporary measure when insurance wasn't coming into this market, but now it's here. Me as a person, if I'm paying 20% of my income towards a potential medical emergency, then I also don't want to be paying a much more reasonable insurance policy. Effectively, we're being double insured, and high quality, especially smaller scale project developers cannot afford that. 20% is a huge margin for many projects. So what is the stance on that, and where are the conversations going to remove buffer pools? Thank you.
And some buffer pools are more than 20%. So it is an inefficiency that we need to address, and we hope that insurance can address it. I'm wary of sitting here and being critical of the early movers, and exactly as Tommy was saying, this industry started off with NGOs and people who are really trying to make a difference, coming up with the structure to make things work. As we've evolved, I think we've got new mechanisms, and I think insurance can displace the need for that. I'm wary of using the word tax, but that tax being in the buffer pool, which has become so hard to manage. And so it absolutely can be an alternative to that scheme, as long as you've got an alternative rating methodology that isn't reliant on buffer pools.
But just so everyone's aware, as for what a buffer pool is, when you're a project type, there is the way it was created originally is that you would pay into a pool in case there was some of the projects failed. So that's basically what we're talking about. And how much should you be paying in, and how accurate is that? Yeah, we could talk for hours on this. Basically, they're reappraising. It's insurance is really the answer. You have to have real-time risk. But then insurers have to have their own versions of this, which is a far more interesting conversation of how do you actually ensure a like-for-like outcome. Which, you know, are you doing the financial side, or are you doing the... No, exactly. So I think that the buffer pool era is ending for reasons that you explained. However, what's the time frame on that? Probably over the next 5 to 10 years, which is very slow for the people who are going, well, I'm giving you a lot. Yeah, so I understand the pressure from your perspective, but it's really that's the exact thing what you want insurance to be solving, is replacement solutions.
And if I can just come back, so most of you that buy insurance, if something goes wrong, you get a check. And the point that Tommy was making is that to be made, and we call that making you whole. Insurance should put you back in the situation you were prior to the incident. And in the world of carbon credits, putting you back in the situation you were prior to the incident would be for you to have comparable carbon credits and to still have that amount of carbon sequestered. And so insurers are responding in two ways. Some insurers are giving you the dollar value of those carbon credits, so you can take those dollars and you can buy something with equivalent value. And some insurers are offering carbon as by way of a repayment. The challenge is the interoperability of that carbon. If you are paid out in carbon, does it have the same characteristics of the carbon that was lost? And the insurers certainly don't have pools of the scale to be able to guarantee that at the moment, although there is an ambition to make sure that they're supporting developers and also off-takers in giving them what they need.
Hi. First of all, thank you so much for the great panel. I'm Hatice. I'm from the University of Vienna. And my question is going to be from the legal perspective of voluntary carbon credits. And so my question is, what are the legal risks you have seen in the system? Like, what are the most common legal disputes, or are there any legal gaps you have seen? Thank you.
I mean, one of the main ones will have to be, does the project proponent own or have a a genuine lease to the land on which they're developing the project, especially for land-based projects. So, there have been a number of very high-profile cases of projects that were actually on land that was owned by the state or by the government, or the person had some documentation, but it didn't give them the rights to the carbon produced on that land, right? So one of the biggest legal risks is around, in any given jurisdiction where you're operating, what is the legal status of carbon? Is it clearly defined in law as being, for in Brazil, carbon credits are a security. It's one of the only countries that's defined carbon credits as security. Elsewhere, it's linked to the land tenure. If you have sufficient land tenure, you have the rights to gain carbon from that land. In other countries, you might have the government owns all natural resources, and so you have to get proof that the government is ceding the rights to those natural resources to you. So, and that's different in every single country. So, whenever you're going into a project, whenever you're looking at a project, you have to understand what is the legal scenario for the ownership and profiting of, trading of carbon for the project and for the proponent and the owner of the project.
Do we have any further questions? Well, if there are no further questions, ladies and gentlemen, please put your hands together for our brilliant panelists, and thank you so much.
Thank you to our speakers and moderator for such a wonderful discussion. Please remain on stage for a quick photo.